My guest today is Mark Sobel, a longtime former Treasury International Monetary veteran. He's had responsibilities with currencies, currently the U.S. chair of the official monetary financial institution forum, known as OMFIF. It's a London-based think tank, and he's a senior advisor of CSIS. Mark, welcome. Let's get right into it. You've written op-eds of late, and many are discussing that topic. Is dollar intervention going to occur? It hasn't occurred in the U.S. since March 2011. And of course, we all know that President Trump is in favor of a weaker dollar. Your thoughts?
Well, one cannot predict what's going to happen in this White House, but I've argued that intervention is not a prudent or a wise idea. The IMF, the G7, the G20 economists agree that the primary rationale for intervention would be to counter disorderly market conditions. I don't see disorderly market conditions. Currency volatility measures are low, liquidity is good, bid-offer spreads are fine, so I don't see it there. Now, sometimes people focus a lot on exchange rate levels and misalignments and whatnot. But there again, I don't see very serious misalignments. If you look at a real trade-weighted graph of the dollar, it was very, very high in 1985, way out of line. It was way out of line in 2002, but much less so than in 1985, and now it's not that far out of line. Other assessments of misalignments would say the dollar's overvalued, the euro slightly undervalued, but the RMB and other major currencies are in line.
So, Mark, let me interrupt you there. So basically what we're really, in your opinion, discussing is unhappiness regarding the level of various currencies, whether it's the dollar, the euro, the renminbi/yuan. So to that end, we all know that monetary policy, the movement of interest rates and the interest rate differential have an effect on the currency, obviously. Do you think that there are governments that think their export economies, like the Eurozone and Germany in particular, like China or like Japan, although Japan's a reserve currency or a flight to safety currency, do they like to weaken their currencies? Isn't the notion that that ultimately helps their export market? That is going on to some extent, wouldn't you agree?
So right now, I would say it's the White House that's unhappy about currency levels. When I look at the European economy, I see a weak economy, low growth, persistent undershooting of inflation, unhealthy banks, negative yields. So I would say there's a case for monetary accommodation within the Eurozone. Now, clearly, that is going to have an impact on exchange rates. Exchange rates are part of the monetary policy transmission effect. But I think that
so in a way, but Mark, so in a way, we're looking at the wrong dynamic. Maybe it's not manipulation, but the end result is the same. I mean, in France, their two-year note is approaching minus 70 basis points. The two-year note, the shots in Europe, is already very close to minus 80 basis points. Yeah. And they're talking, the ECB, about more stimulus. Christine Lagarde most likely will carry the stimulus torch. I guess what I'm really asking is, while implementing policy to try to address their weakness, it's going to push their currency lower, exacerbating the president's unhappiness with a weak dollar, a strong dollar.
I agree with you that European monetary policy accommodation could have an impact of somewhat weakening the euro. Hopefully it would also help contribute to a healthier Eurozone economy. But frankly, I think monetary policy in Europe is overburdened. I think that countries with fiscal space in Europe should use it, and they should act more vigorously to strengthen banks and take other measures to support the European economy. And again, as I said, this would help deburden monetary policy, in my view.